name's Della. I am the branch manager and vice president of our Pueblo downtown location. I have 27 years of banking experience, so wealth of knowledge that I'm absolutely willing to share. So if you have a question outside of the topics that we've been asked to present today, let me know. I'm more than happy to try to help you out. So Vectra Bank has been asked to talk about 4 components of loans. And the first one is, what's the difference between credit and debit cards? So as you can see here, there's credit cards on the left and debit cards on the right. Starting with the credit card, when you use a credit card, the funds that you're utilizing are not tied to your bank account. It's a loan. So it's not directly tied to the account, where a debit card, you swipe that card and it automatically is going to hit and come out of your outstanding balance or your current balance of your account. A credit card can help you establish credit or improve your credit. So again, it's a credit product, where the debit card has no impact on your credit score whatsoever. The credit card will accrue interest if payments are not made on time. Most credit cards, there's an interest rate tied to it because it's the cost to do business or the cost to borrow the funding. Usually, most cards, if you pay it off monthly before the statement cycles, it forfeits the interest owed. And that's a really good way to utilize a credit card. If you do not, then you're going to pay that interest charge. Also not noted on here is, if it's not paid on time, then there's an additional late fee that could be pretty hefty as well. Where the debit card does not typically offer any type of rewards or anything beneficial to you for utilizing the card, if that makes sense. The credit card does offer the ability to earn rewards or perks tied to your spending. So a lot of credit cards nowadays you can earn cash back, or you can earn reward points based off of the utilization. And you can go on and either redeem the cash back to pay towards your statement, or you can redeem it to yourself. Or if you're utilizing rewards cards, sometimes you can go on and order gift cards. It just really depends on where you have your card. And again, a debit card doesn't give you really any rewards for utilizing it. It's great. A credit card is great for larger purchases or for traveling, where a credit card is good for like day-to-day swiping. So if you're running to Starbucks and you're going to grab some coffee, or, well, hello again, or you're going to be, going to lunch quickly, or whatever that looks like for you. One of the things that there's a lot of opinions on credit cards, credit card versus debit. And you may hear some older people say, oh, don't get into a credit card, you'll get in trouble. Well, if you utilize a credit card the way it's intended, it could be very beneficial for you. And what I mean by that is, 1, it could be a great way to prevent fraud. In other words, if you're swiping your card all day long and there's a skimmer that's been put onto the ATM you've used, or even a merchant, those things happen. That's how fraud happens. And they use that card, it's going to hit your account directly, the debit card. Where if you're using that card and the same thing happens and you get subjected to fraud on a credit card, it's hitting the bank's money, not yours. So there's some benefits there and some protections in place to be able to prevent fraud from hitting your actual account. Now, there are ways to dispute fraud, whether it be on a credit card or be on the debit card. But on the debit card, again, it's directly hitting your account. It could take a certain amount of time for you to get reimbursed, and it could be impactful to you. So just some things to think about on the differences between the credit and the debit card. So any questions? I know you just popped in.
Well, I'll just make a comment. I've actually had that happen to me here in town at the gas station off of Lake on the south side.
Yeah.
Used my credit card over there, and somebody happened to hack into the gas pump, and they were using my card. So I didn't even know anything about it until my card was canceled. And that's when I called the bank, and they're like, oh, yeah, there's some fraudulent activity. We canceled the card. But don't worry about it, because it was the credit card, not your debit card. You don't have to worry about it.
Yeah. And whether it be the credit card or the debit card, we can dispute on your behalf. And typically, depending on your institution, which most of them have some sort of fraud department, where you may get a call, they may freeze your card and you have to call and confirm, is this your transaction? I do know at Vectra Bank, our fraud department is very quick about shutting your card down if they catch it, if they suspect it as fraud. Most companies will. It can be frustrating because you're like, why is my card frozen? But if they suspect any fraud, because it could be unusual activity, or maybe your card is getting old and you're multiple swiping, those could be things that could red flag your card, and your bank may freeze it until they can confirm with you. So thanks, Felipe. Do you have any questions on the credit cards? Okay, awesome. So like I said, the benefit to the credit card is it can be another way to pay yourself back. For your spending, you're going to accrue those reward points or the cash back. Where if you're just swiping a debit card, it's just money gone and you're not receiving any benefit for that. So the next topic that we were asked to talk about was, what are the different types of loans and investments? So there's many different types of loans that you can take out, as you can see down here: payday loans, personal loans, cash advance, credit cards, auto, home, a mortgage, which typically goes and coincides with the home, debt consolidation, a student loan, or a business loan. And some of the notes I made, and I think on your copy, I had already put my notes down, so that may not mean anything to you, but some things I want to highlight is some of the higher risky loans charge the most. So for example, payday loans. Payday loans, I'm not even sure if there's a place in Pueblo that even does those anymore, but do you guys know what a payday loan is? You familiar with it? That's good. It's good that you don't. But a payday loan is a place where you go and you say, I need to borrow money until I get paid. And they'll say, sure, how much do you need? And you can borrow $200-$300, but you're probably going to pay like $50 when it's time to pay that back. And when I first got started in banking many years ago, we saw a lot of people fall victim to payday loans because they were constantly borrowing from Peter to pay Paul. So they just got caught up in this cycle because it was so expensive that by the time they got paid, their money was gone again, paying that loan back, and then they had to do it again and again and again. Where it got to the point where then they just couldn't keep up with it, and their accounts became overdrawn because those payday lenders are going to cash that check regardless. So that's a really negative way to borrow money. A personal loan can be great. It is something that's typically done through a bank or a financial institution or a financial lender. And a personal loan is typically where there's no collateral involved, where you just go in, they're going to pull your credit, take a look at, are you credit worthy, and is this person likely to pay us back? Those can typically be higher interest rates, again, because there's no collateral tied to the loan. A cash advance is typically can happen a couple of different ways. It can come off of a credit card, and where you're going to pay that higher interest rate again. So if anybody already has a credit card and you get your statement and you can see that they're going to tell you your interest rate is 18%. And that's typically for everyday swiping purchases. But in the fine print, it's going to tell you if you do a cash advance, it could go up to 27%. It's very expensive. So the cash advance and the credit cards kind of go hand in hand. So those are very high interest rate types of ways of borrowing money. An auto loan. An auto loan is a lower risk loan because there's collateral tied to it. We're taking collateral and securing the note with the title of your vehicle. So you can typically get a lower interest rate. A bank will determine what is the value of the vehicle. So whether it be a brand new vehicle or your used vehicle, maybe you don't owe anything on it and you just want to take a loan out and get the cash. That's a good way to borrow as well. A home loan. So a home loan and a mortgage, they kind of go, again, hand in hand. They're usually a longer term loan. Some of these other ones I talked about are very quick turnaround times. An auto, I believe you can go as long as 7 years, where a mortgage, you can go all the way up to 30 years. And one of the things that we really encourage our borrowers are really, what is their financial goal? How long do you want to be in your mortgage? For example, somebody for me, I may not want to be in a 30-year mortgage because I don't want to still be paying that as I'm, elderly. Where somebody like you, you've got plenty of time to go in and really pay down that 30-year mortgage. So when you do buy your first home, those will be some things you really want to sit with your lender and talk about. If they're really a strong lender, they're going to ask you those questions. Not only does it matter with how long of a term you want, because you can go 10 years, 20 years, 30 years, but you're going to want to make sure that the payment you have is affordable. And so right now, interest rates are climbing, values of homes are rising, and so people are having to take that longer term in order to make their payment affordable. So, but a home loan is always a good investment. And we'll talk about the investment piece here in a second. Another type of loan is a debt consolidation. And we do these for our clients all the time. So we might have somebody who maybe didn't use their credit card as it's intended, where you utilize it and pay it back, utilize it and pay it back. And maybe they have student loan debt out there, or they've got other loans and they're like, man, I can't keep track of this one's due this day, this is due this day. And we may sit down with them and say, hey, let's talk about a debt consolidation and put it all into one loan. You'll have one payment, one interest rate, and you're going to get it paid off. And that can be done by securing it with an auto. We can do an equity line on their home. It could be unsecured. There's numerous ways for somebody to do a debt consolidation. And then there's student loans, which a lot of college students may have. You may not understand fully how those work yet because they're probably deferred until you're out of school and you have to start paying those back. But we do a lot of student loan debt consolidation for people as well, because you may have multiples as you've gone through school for 4 years or however that looks for you. And then the last one is a business loan. So we do full-blown business banking at Vectra Bank. So if you one day decide you want to become an entrepreneur, start your own business, it's really good to sit down with your financial institution and say, hey, how can you help me get there and help me grow my business? So the loans that are, when it says what are the different types of loans and investments, anytime you're purchasing something. So if you're purchasing a home, you're purchasing a vehicle, or you're purchasing any type of personal property, that's an investment for you. That home can increase in value. Your vehicle, you need that to get to and from everywhere you go. And so those things that's an investment for you. Where the other types of loans, there's really no collateral and it's just, there's no return for you, nothing in it for you. So lots of different ways of doing loans, lots of different ways that the banks are, and like I said, myself at Vectra Bank, how we help our clients to find what's the best fit for them is just discovery process and learning about their situation. Yes.
I had a question regarding the student loans, FAFSA, unsecured or subsidized, unsubsidized, I believe. When would you recommend a student go in and have a conversation about consolidating that loan into would it be before the deferment period ends or after they start that part of it?
I would really encourage before, at least to get the education. And also, I know that I'm not the student loan expert because we don't necessarily do student loans at Vectra Bank, but we help a lot of people through them with, like I said, the debt consolidation. But we always encourage to be proactive versus, oh no, my payments are due. And then we're reacting to, what if I have 4 student loan payments and now I'm struggling to meet the due dates, and we can proactively sit down and talk about putting you in a better position before you're subjected to the payments. So that's what my suggestion would be. But good question. Any questions for you, either of you two, on the loan types or investments? Okay. So the next section, we were asked to talk about basic requirements for loans. This is very, very basic, but and I can dive in a little bit on the different types of loans. But in a nutshell, we have to be able to identify the borrower, so we'll need some sort of valid ID, and an address. So we cannot use a post office box. We have to have a physical address, and most institutions will require that. Just using a PO box could be a red flag for potential fraud. So we do use a physical address. Verifiable income. So we can have somebody who comes into the bank and they say, I make $5,000 a month. That's great. Can you bring us proof? We have a lot of people who may work and make that much, but they get paid under the table. And so there's no proof of us to be able to verify they truly, in fact, earn that amount of money. So when we verify income, it's either going to be with pay stubs, with a tax return, or bank account statements if the money is direct depositing. So we do require verifiable income for the borrower. Now these numbers in here are not set in stone, depending on the lender. So a credit score of at least 640. Now I know if you go to do traditional bank financing, it could be a more stringent requirement, where there's a lot of other lenders out there that do take on, I'll say, higher risk, maybe a lower credit score or a short time on their job, and they can do the loan, but you're going to pay a little higher. It's a higher cost of a loan. And then same thing for your debt to income ratio. So what that means is they're going to take a look at what is the amount you're going to owe and how much income do you have. And the bank is going to look at a certain percentage. That can range anywhere from 30% to 45% to 55%, depending on the type of loan that you do. And depending on credit score, all of those things will factor in. So there's so many requirements that could go into a loan. Just depends on what type of loan that you're doing. But these are the basics. For example, if you're doing an auto loan, we're going to want the title of the vehicle. We're going to want proof of insurance that in the event you get in a car accident, that the dollar amount is going to be replaced to pay your loan off. Those types of things. If you're doing a mortgage, same thing. We're going to want to see homeowners insurance for your home being insured. We're going to want to see a replacement line in there because maybe what you bought your home today, and if you have to replace it in 10 years, it may be way more in 10 years to replace that home. So there's a lot of requirements that could factor in, again, depending on the type of loan that you have. And also based off your credit rating. So you probably see my note here that those two things, line item there, is really to earn the best rate, and it's driven by A+ credit. So again, lenders can go off of different ratios, but you just pay a different interest rate, or maybe your terms could look differently. Any questions on that part?
I actually have one. It kind of goes back to
Sure.
the different types of loans. For a new homeowner, I've heard that they can potentially get lower interest rates and lower the loan. They're a new homeowner.
Yeah.
But how does that work?
That's a really good question. So there's so many types of home loans that you can actually do. First time home buyer. There's, if somebody's a veteran, there's a VA program. There's a lot of different programs that will allow you certain perks and benefits if you qualify for that program. So such as CHAFA. CHAFA is one of those programs that you may have heard about, that they even can help with down payment assistance. So it's really going to determine the type of loan. The lender should be talking to you about your options and your specific situation to determine which program will be the best fit for you. But that's a great question, and you are correct. I do know at Vectra Bank we have a program that qualifies you for some amazing perks just by the zip code of where you're purchasing. And again, it could potentially give you down payment assistance. There's something on a mortgage called mortgage insurance. So typically, if you are borrowing more than 80% of the value of the home, they're going to require you to have mortgage insurance. And that mortgage insurance does nothing for you. It protects the bank, the institution. So there's ways to have that mortgage insurance waived, again, just based off of the type of program that you could potentially qualify for, which is great. But that's a really, really good question. Any other questions on that? No? Okay. So we'll dive into how to shop for the right loan. And that's a loaded question. So I really thought, instead of putting down specifics, really my advice to you is establish a relationship with your bank. It's really good to have a bank, but when you have a need, do you know who to call and pick up the phone? Are you just an account number, or can you go into the teller line and say, hey, whoever, if they know you by name, and you talk to them, I'm thinking of buying a home, or I'm really thinking of buying a car. Who can I talk with? Get that warm handoff to a banker and let them really tell them what your need is. If the banker is doing their job correctly, they're going to ask you a lot of discovery questions to really understand what is it that your goal is. And then they'll help guide you, educate you on the options so that you can then make the best decision for you. There's really no cookie cutter best type of loan because what's good for me may not be good for Felipe. Our situations could be completely different, just like the two of you. So it's really important to talk with that lender and really let them know this is my goal. And if you're not sure what your goal is because you're brand new to this, they should be asking you a lot of questions to help you uncover. Are you really looking for a payment? What can you afford? Or are you looking for the best rate? What is truly the best fit for you? A lot of times in lending, you're always going to hear, oh, the interest rate's way too high. And it depends. It may be way too high for somebody who can do a really short term and pay that off quickly, who's been a very established borrower. But for somebody who's newer, maybe they need to go a longer term and have that affordable payment at a little higher rate. Because the good news about any loans is they can always be refinanced at a later time, and that you can maybe start off entry level somewhere, but you can always refinance into a better situation later. And again, that's what a banker should be sitting with you and discussing. A lot of times when people buy a mortgage, they never stay in it for 30 years. Very, very rarely. And the reason why is because their situation could change. There could be interest rates. Maybe they got in at a high rate and now there's promotions everywhere, or maybe their value has increased and now they want to take out an equity loan and do some like home improvements or whatever that looks like. So if you do buy your first home and you're in something that maybe you're like, man, I don't want to do this for 30 years, you're never stuck in that. It could be just temporary to get you into what you need for the situation you're currently in. So my suggestion for how to shop for the right loan is just establish a great relationship with your bank, know who to go to when that time comes, and sit down and just have a conversation, get the education so that you can make the best decision for you and your situation. So those were the 4 topics that they asked us to talk on today, but I can answer anything else at all, anything banking related, I'm happy to. Yes?
I wanted to ask a question about if you go in, say, for example, knowing that you need to get a loan, but not exactly knowing how much you need or which way to go about it, what would be the minimum information you'd like to see? Would you like them to run a soft check on their credit and bring that report to you?
So typically what we'll do is we'll sit down. So if, I'm going to use this as an example. Say you're coming in and you're like, I want to buy my first home. I found it over here. It's $100,000. So we're going to sit down and say, this is amazing. Let's talk through this. We're going to ask you how much you make on a monthly basis. We take into consideration other debts that you'll be paying, including that new mortgage. We take your income, we take all your debts, and we put it into a calculator that will then give us your debt to income ratio. We're going to ask you if you've ever had credit before. If you haven't, then we are going to know that there's probably not a credit score to pull. Or if you have had credit, we'll ask you things like, how long has that been established? So what types of credit do you have? Is it, credit cards, auto loans, whatever that looks like. So there's, again, that discovery process that we'll be asking the borrowers to obtain the necessary information to know what they can qualify for and to give options on what types of loan products. Does that help?
Yes, thank you.
Sure. Any other questions or thoughts that you guys have? I'm happy to answer, even if it's not loan related. I know you had talked about credit. I'm happy to answer credit questions too.
The only thing for me is like, so when you're getting, because I know there's a lot of reward programs, is there any that you specifically are worthy and maybe what you think?
Like for a credit card?
Yeah.
Yeah. So I think anytime you're going to get rewarded, it's great. There's so many credit cards out there, and probably you're already getting stuff in the mail constantly that'll say apply now, and you're getting in there. There's some really great offers out there. I think what you really want to do is pay attention to that fine print, because you can get into a rewards card or a cashback card, but if you're not paying it off monthly, then the interest rate could really be you're not even earning any reward because the rate is so high. So there's a lot of fine print. I think the best thing, that's what's great about doing business with your bank because you can go in and sit down with and talk with somebody. Where a lot of the credit card offers are amazing, but you're not going to have anybody to really just sit down with you and help you understand the features of the product and the benefits to you. So, and then doing your own due diligence, what is my situation and what is this card offering me? And really understanding. I always encourage my customers to do their homework, understand, ask questions, so that when they're signing or the bottom line for anything, that they know they confidently understand what they're obligating themselves to when it comes to lending. Sure. Yes. Yeah, absolutely.
So on the credit cards, talking about the cash advance that you had mentioned before, is there a way that you can dictate how the payment that you make goes into paying what first, whether it goes to paying your minimum balance and then your cash advance or vice versa, where you're paying that higher interest bearing loan off first?
So it depends on the card and the lender. So for example, I know at Vectra Bank we do we'll mail out credit card checks, and it'll say, from this time to this time you're going to earn a promotional rate. And when you use that check, it's going to take that portion of money, and when you make your payment, that portion of money will receive that special rate. And a lot of card companies do that. Again, when you get a card, there's like a pamphlet this thick of disclosures. So those are really good questions to really dive in and try to see exactly what that specific card will do for you. But like I mentioned earlier, there could be different rates. They're going to say you're going to get this overall rate, but it could be only for specific types of transactions. And then other transactions could be at a higher rate. So that's where you want to really be careful with the fine print and reading. There's usually an insert that tells you the rates for what the activity will look like.
Right. And whenever you make your payments, is that you can tell them I want to pay, say for example, your minimum payment is $35 and the cash advance. You tell them I want to pay $100 and 35 of that going to my minimum payment for the outstanding balance.
Again, that's going to be specific to the card and the type of promotion that they're offering you. Yeah, but there are ways to do that. Again, it just depends on the type of card and who you're with. Yeah, that's a good question.
They're always sneaky like that.
Yes. And that's why I say people will say, don't get a credit card, they're awful. But if it's truly used as it's intended, which is short-term borrowing, long-term borrowing means it's a term loan for a specific amount of years or months. But a credit card is meant for short-term borrowing, meaning it should be revolving. So if you have a $5,000 credit card and you swipe it for $1,000, the intent is to pay that $1,000 off shortly versus now I'm going to make monthly payments for the next 5 years. And at the end of that, it's so expensive and you really aren't getting ahead. So any type of revolving credit, whether it be a credit card, or you can do a line of credit, unsecured line of credit, or you can do a HELOC, which is a home equity line of credit, which is using the equity in your home. Any lines of credit are truly meant to be for short-term borrowing, so less than a year. And you'll want to revolve, and it'll revolve. So as you pay it down, then you could use it again. So there's a lot of advantages to using credit cards. You just have to make sure you understand how to use them and use them accordingly, properly. One thing a lender will look at is the percentage of utilization. So if you have a $5,000 credit card and you have $4,700 utilized, that could really be negative on your credit. They look for about a 30%, 30 to 35% utilization, and that can be beneficial to your credit score. So really, it's just the discipline behind how you utilize that card and understanding all the fine print. Any other questions about anything at all? I can be a resource for you. I have a guy. So at Vectra Bank, I do work with a lot of clients, and then I also have a lot of contacts. So I always tell my clients, use me as a resource, whether it be about banking or not, because I know a lot of people and I can give a warm handoff to try to help somebody get what they're needing. So
you were mentioning the debt to income ratio. For the debt portion, credit cards contribute to your credit score. Is it a better idea to have multiple cards at a lower limit or one or two large cards that have a larger
Mhm.
limit.
So that's going to be very individualized. Credit, there's a lot of moving parts to credit, and it's going to depend on what all other types of trade lines is in the credit report. So if somebody has one credit card and it's a high limit, or they could have 3 credit cards with a lower limit, like it just really depends on the individual's credit situation. Um, we do encourage credit monitoring apps that are out there, like Credit Karma or Discover. A lot of them have them. What I encourage them for is the credit score is never going to be the exact credit score. But what's great about them is it's going to tell you your utilization of your cards. It's going to tell you if there's any new debt, possibly that you didn't do yourself. It could be a good way to monitor your fraud. But you can also get your free credit report on an annual basis just by going to creditreport.com, and it's free to you. But I encourage everybody to pull that, whether you have had credit or not, because fraud is the biggest industry right now, unfortunately. And we have seen borrowers come in, try to take out their first loan, and there's these things hitting, and they're like, I didn't do those. So if you have some sort of credit monitoring, it's going to tell you. And I get notifications a lot on my credit because I do use Credit Karma. I like that one. And I did just apply for a new credit card for airline miles. And it told me that. So it'll tell you. So if somebody is taking credit out in your name fraudulently, you're going to get some sort of notification through some of those monitoring agencies. So, but there's a lot of, credit can be intimidating and it could be scary, especially if it's the first time somebody is utilizing it. But I think the biggest thing is education, and that's great that you're here today and really establishing that relationship with your bank so you know who to go and talk to help guide you through that process. Is what I recommend. Any other questions I can answer? No? Well, I'm glad you guys were here today. Like I told you earlier, this is one of the favorite parts of my job, is being able to help educate, because without knowledge, it's hard to make decisions. And so the better knowledge you have, the better decision you can make when it comes to things like this. So yeah, thank you.
Thank you.